Thank you for the kind introduction. It's a great honor to be here. I think this is more about this new area, emerging area that I'm super excited about. I do want to share with you some of the work that my co-authors and I have been looking at actually over the past 5 years. It was actually difficult to convince the referees to that reinforcement learning or transformers are interesting things to look at back then, but transformer is the T in ChatGPT, so now I think it's an easier job. I'll briefly touch on a couple papers, but I mostly want to focus on the overall agenda. And the overall agenda is about building AI models for finance. Most of the AI or even machine learning models off the shelf, they were not initially designed for financial application. In many cases, they were designed for other engineering problems, bioinformatics, so on and so forth. And also nowadays, when we see large models that are opaque in a way, both in terms of data sources and also in terms of the algorithm itself, we have to do something about it, both for interpretability and also for understanding, whether our model is robust and all that. So building the model from scratch will be costly in terms of computation, but if we tweak them, tailor them for financial applications, I think they are still manageable. So that's what I want to focus on. And so I'll start providing a little bit of background, right? Why we need machine learning AI models? I think with this audience, that's not a tall task. We do deal with high dimensionality, nonlinearity. We know that. What do we do? We reduce dimension, right? Penalize regressions, PCAs, and all that. We have nonlinearity. We can take non-parametric models. We can use neural nets that are very good at incorporating nonlinearity. We have interactions that are different from science and engineering data, which tend to be sparse and less endogenous, right? They are controlled lab experiment data. Over there, people worry about sparsity of the matrix that they have to invert. But in our cases, we have to think about interactions, and regression trees or classification trees would be very powerful, as seen in many other fields. We have very low signal to noise. That means we have to be very careful with auto-sample tests. And we have low signal to noise for a reason, right? If a signal is very informative, people trade on it, and it's going to become noisier. And our traditional time series analytic tools, ArchGarch, ARIMA, and all those have strong assumptions on stationarity or meta-stationarity. I'm not saying machine learning or AI models don't have those assumptions, but they are a class of more flexible models. So presumably you can extract a bit more information in time series. Most of the AI models that we saw this morning, or even just here every day, are sequence models. They focus on time series analysis. Because for machine translation, you just read in sentence by sentence. You do the translation. They are very effective, so we'll tap into that strength. But at the same time, at least for asset pricing, we've done so much work in the cross-section. We know information is very rich. Interactions of assets are very important. Those models were not designed to handle multiple sequences. At least the AI models were not. So we probably have to tweak that a little bit. But luckily, we can easily move the structure from the time series into the cross-section to extract more information. I'll give an example on that. So these are the kind of data background. And I'll try to convince you that some of these issues or applications are well economically motivated. In a way, we're not trying to leave everything to the tools, right? AI and machine learning models. We're trying to incorporate some economic restrictions and guidance in the process. Another thing we want to emphasize is interpretability, which is important for us to develop new theories to prevent overfit and figure out regime switches. So what is the status so far? If we think about machine learning AI applications in AI, in asset pricing and investment, we've seen a lot of off-the-shelf prediction-based exercises, which is useful to do, but they're restricted to prediction. There are other papers trying to impose or incorporate economic structures, which is very helpful. They are mostly supervised learning based, right? You have historically labeled X and Y variables. You basically teach the algorithm through examples. That's in asset pricing. In corporate finance, there's less application. Textual analysis is a big thread of literature. And actually, we were talking about what is the state of art, right? So there's been topic modeling that David Blay, Andrew Ong, and Michael Jordan introduced in 2002. There's a word embedding, word to vec 2013. I personally have done some work, and that's combining word embedding and topic modeling. And I think Holberg and Halley, they have a JPE publication combining the two methods as well. But those are outdated by now, right? Even in economic and finance applications, there has been papers using word to vec. For example, Kylie and co-authors a paper on measuring corporate culture. So there's that. And of course, now we have the large language models that are very interesting to explore. Again, so that's the textual analysis, nothing causal, and it's typically a prediction-based exercise. Now, in other areas outside textual data, we've also had papers looking at how machine learning can help select managers, board of directors for venture capital investments. Again, that's a supervised learning-based prediction exercise, which are very helpful to do. But if you think about the latest AI development, right, AlphaGo, self-driving, ChatGPT, almost all of them, they don't use, their main algorithm is not supervised learning. Their main algorithm is something called reinforcement learning, which I'll come to. So they are not really learning through examples. The modern AI algorithm, most of them, are basically specifying a objective and have a very rich space of model, very large model, over parameterized. And then they try to cleverly figure out what is a good model, what is a good solution to the objective. So that actually relates to the development of AI, right, over generations, right? Earlier on, it's about automating physical processes, then automating computation steps, right, our computers, calculators. And nowadays, when we think of AI, we're really thinking of automating solving complex problems. That's why they appear to be intelligent, right? It's such a complex problem, yet they can give a solution. So that's why I call this theme goal-oriented search. They are typically requiring specifying a goal and a large modeling space. If you are talking about a control problem, as action space, and then search for a good solution to optimize your goal. Now, you can do a full search, just like supervised learning can be used in AlphaGo, but that wasn't done because it's computation-wise, it's too hard, right? It's too much. That's why we have to do some shortcuts. We have to do some approximate search in that large solution space. Now, in a way, linear regressions is a restricted modeling space, right? It's a class of models, but it's a subspace of the full modeling space. So the direction I'm trying to suggest is we can search in the larger modeling space. Sometimes it's theory inspired, sometimes it's purely data driven. That's fine. We can uncover some patterns that'll be useful. So I'll emphasize two major search algorithms. One is related to heuristic search. That's related to actually ChatGPT, AlphaGo, and all these reinforcement learning. The idea is you take an action, you interact with the environment, you get feedback, you fine-tune your model, you interact with the environment again. Right? You're optimizing while learning about the evolution of the states of the system, both the environment and internal states. It's very relevant when it comes to corporate finance decisions. Internal states will be firms, internal reports, accounting variables, so on. So in terms of investment, right, we can search in a larger modeling space where we map inputs to portfolio construction directly. In terms of our usual asset pricing exercise of sorting, security sorting, right, double sort, triple sort, creating test assets, we've been doing it in an ad hoc way. Why do we do double sort? Why don't we do quadruple sorts? We have so many characteristics. The truth is, if you do a full sequential sorting exploration, it's an NP-hard problem. There are too many permutations. That's why computation-wise it's not feasible. But there are greedy search algorithms that will allow us to explore that space more so that you can create assets, for example, that better span the efficient frontier and better help us to construct the pricing. And lately, I'm more excited about applications in corporate finance. I'll come to that in a bit. So that's kind of the general background. Now, the first search is efficient heuristic search. And in the AI field, it's mostly done through reinforcement learning. And here are a few examples. You need to split. Basically, the conjecture is for any goal that we have, you can formulate that as a cumulative reward. There are papers challenging that statement, but in most cases, in most AI applications, that's taken as given. Given that you can write it as a cumulative reward, now you can think about how you dynamically, optimize this objective. And portfolio management is just one example. There are many books written on reinforcement learning. So it's actually a well-established field over the past 10, almost 15 years. It's new to social science in general, so I think it's wide open. It offers a third paradigm, an alternative to supervised learning, which is based on learning through examples, and unsupervised learning, which is based on correlation of X variables only. And I already mentioned that idea, right? It's about interacting with the environment to train a model. So that's one way of search. Why is that an effective heuristic search? The idea is it's dynamic programming, right? I explore a little bit. If it's promising, I try more. At the same time, I explore some other space. So it's approximate dynamic programming idea. Another very effective search would be a greedy search, and regression trees, classification trees would be a good example. And why do we advocate trees? In a way, trees are computationally feasible because it's greedy. Why is it greedy? Well, trees are about clustering observations, right? Once you grow one branch, you do one split, you fix that and think about subsequent branches. When I do the fourth split, I don't go back to the first one and say, oh, what if I use a different characteristic and threshold to split my sample? We don't do that. That's why it's greedy. But greedy makes it computationally feasible. But there are many other benefits. Trees are way more transparent. You see the exact structure, which variables interacted, which factors mattered, which characteristics interacted. You know exactly how to construct a leaf portfolio, right? Once you just use our usual data sets in finance, you can do a lot. It's essentially a non-parametric kind of partition of the space. And in the interest of time, I wouldn't go into more details, but they are known to capture interactions very well. They are also known to deal with shorter observation window and low signal to noise, sometimes even better than deep learning, deep neural nets. And statisticians will love tree models because you can typically prove, some asymptotic property convergence, whereas that's still work in progress for deep learning, right? Or even reinforcement. So here comes to our first application. We changed the title a little bit. Now Transformer is a little bit more visible. But we actually did this towards the end of 2019. That's only 2 years after Transformer was introduced. So I'm happy to be proven wrong. I think it's probably the first large model in finance. We did have over 10 million parameters. That was a downside. People were saying, you had data mine and all that. But now it's actually okay because there are papers showing the virtue of complexity, the virtue of over-parameterization. And there are intuitions discussed in these papers. Basically, large models, I think very recently in this, I didn't list that paper. In one paper in econometric, large models are shown to be more robust and effective than sparse models, right? And why do we want sparse models? Well, oftentimes we want the model to be simple for interpretability, also for easy estimation. But now computation is such that you can estimate large models, and they are actually very effective, as seen in the case of ChatGPT. They are typically trained using reinforcement learning. And reinforcement learning actually shares a similar spirit to what is called grounded theory in sociology. That's a very popular paradigm in sociology. The idea is we don't just test hypotheses. We have some idea about the world. We go to the data, have some interaction. We come back to reformulate our concepts. We go to the data again. So it's an iterative process. It's exactly reinforcement learning, even though it's done in a non-quantitative fashion in sociology. So it's actually a common theme. So coming back to portfolio management, what is the economic question? What's the economic motivation? Right? Typically, we do portfolio construction. You give me any arbitrary objective. We do portfolio construction in 2 steps. Right? Typically, we do pricing first. Want to minimize pricing error. We want to estimate the kernel. Then we do portfolio construction. Now, if you give me the estimates of the first 2 moments, I can do mean variance optimization. Right? Almost trivially, even though that won the Nobel Prize 70 years ago. So the first step is the challenge. It's hard to estimate the expected return distribution and all that. But if you take a step back, is that crucial for my portfolio management? If I have a long-only portfolio, and I already know what asset's first moment expected return to be super negative, do I want to use my limited statistical power, limited data, to estimate its other higher moments just to price it accurately for my portfolio? No, it's irrelevant for my portfolio. It's not going to be in my portfolio. For asset pricing, yes, we care about exactly recovering kernel out. And if we have infinite computation, infinite data, we should do that too. But here we have limited data, so maybe we should optimize the objective of portfolio management directly. And that's an idea that was introduced and discussed in the earlier literature as well. I think Brand and co-authors have done a lot of work there. Back then, they were not able to handle the high dimensionality of financial data. Non-parametric estimation can rarely go beyond 2-3 dimensions. They have to construct indices, right? Some linear combination of firm characteristics and things like that. Or you do a parametric approach, but it's subject to misspecification of your intermediate model. Just like when we do asset pricing first before constructing a portfolio, it could be that my asset pricing model is wrong. So reinforcement learning is a very natural candidate for doing it. And supervised learning isn't. Because for an arbitrary objective, sometimes we just don't observe the historical correct answer. The data are not labeled. If it's about return, yes, I can observe historical return, take an average. But if it's about cumulative return for 12 months, subject to never losing 50% my investment, that's not observed in either market signals or firm accounting fundamentals, right? That's not the problem for reinforcement learning, because reinforcement learning only requires you to specify a goal, a reward. You can say my reward is, my cumulative performance subject to never losing 50% of funds under management. And the idea is, okay, I specify a really flexible modeling space, a large model, many parameters. I just try it and see how it does. If it's doing well, I search more in the parameter region that it's doing well. If it's not doing well, I search away, right? If you use neural nets, they are typically gradient based and all that. You can figure out which direction I should move my search until it converges empirically. And you can do more robustness by randomly initiating your search and all that. So there are many algorithms within the class of reinforcement learning that allows you to do it. So what we did was we take individual assets inputs, right? It could be book to market ratio, number of employers, I don't know, even diversity of board, earnings growth. Those are firm-specific inputs. You probably observe a time series of that, and it's high dimensional. We basically pass it through what is called sequence representation extraction module. Transformer encoder is an example. It's about taking the time series input, representing it in an abstract vector, Hazer matrices, right? It's about information extraction and representation. We don't have to do decoder because we're not doing translation. We just need to represent information in the time series. But we know there's rich information in the cross-section as well. So what we added was a cross-asset attention network. It's essentially the self-attention network that's used in machine translation as well. You take a cross product or dot product of your first sentence with the 10th sentence, things like that. But instead of doing it in the time sequence, we do it across the section. What exact functions do we use, and what exact optimization algorithms we use actually is not the most crucial part. There are many choices, right? But the main idea is extracting information both in the time series and in the cross-section. And then you generate some score, and then we construct portfolio using these scores. So far, there's no economics, right? So far, we're just extracting information in a statistical sense. And here is the economic goal. Basically, you need to specify an objective. Let's say auto sample Sharpe ratio, just for comparison with other papers and other models. Then I can initiate my model, construct a portfolio based on what we call the winner scores. If it's giving me a high auto sample Sharpe ratio, I'll search more in that direction. Otherwise, I search away until the model converges. That's kind of the basic architecture. And the blue part, we take it off the shelf. Right? You can adjust the number of blocks, the layers of neurons, and all that. This is new. And for reinforcement learning, again, there are books talking about it. We use a policy-based approach. Basically, we say the optimal portfolio management policy is parameterized by theta, and I calculate my objective, which could be the auto sample Sharpe ratio, right, for the next, let's say, 12 months. If moving in a particular direction in the parameter space helps me to improve the objective the most, I'll explore that region more rather than other regions. Right? So that's the basic idea. Now, if you take this to US data, right, the usual inputs, usual firm characteristics, or even macro variables that we can find. So when we were starting this, it is 2017, 2018. So our original data is only until 2016. We are currently updating that. But the training set, we set it to be pre-1990, and then we'll have a test set as well. And this is the main table of performance. Monthly rebalancing, baseline objective is auto sample Sharpe ratio. You can see the Sharpe ratio auto sample is consistently above 2, which is pretty high. And we'll exclude the bottom 10% or 20% based on market cap, because they typically drive anomalous returns, and also, even for other machine learning strategies, they tend to drive the results. Take those out, it didn't diminish. Turnover is low. You hold on average 4 months each asset. You can control for known factor risk factor models. The annualized alpha is still quite high. Now you can do a number of economic restrictions, right? You can take out unrated firms. You can look at illiquidity, different illiquidity episodes, volatility episodes of the market to make sure the results are not driven by prices where it's very hard to trade. You can look at the time, the sub-sample periods of performance. Sharpe ratio was even higher, and then they declined to around 2. And then the excess alpha is pretty high. Now, the most useful feature is actually beyond this. The most useful feature of reinforcement learning is you can specify any objective. Right? I was giving Sharpe ratio as an example, but you can say, the cumulative return subject to never losing 50%. That involves interaction of the manager's action and the states of the system, because my trading action would affect whether my fund is surviving or not, and that's a state variable going forward. And you can also build a market price impact model, where certain trading would have a price impact. Those are all fine. You can build those into environment modules, and in the paper we show a few examples of how the alpha portfolio is still performing well. It dropped quite a bit, right? 1/3 of half of the performance, but still a lot higher than the usual benchmarks. Now, the drawback is that it's not very interpretable. So we did a few exercises to try to interpret that. One exercise is to, because it's neural net based, you always know ex post after training the model which feature is important, because you can look at the gradient that they improve the objective. We take those important features, add their higher order terms and interaction terms, throw everything back into a linear regression. Basically, we try to do a distilled version of the model, not for deployment, which differs from computer science approach, but for interpretation. We just want to see which feature actually matter, and it turns out that the most important feature is inventory changes scaled by total assets. It's actually discussed in the 2002 accounting paper. Didn't get a lot of following, but it turns out to be important. And this second order turns out to be important. We see over time in the test sample rotations between market signals and firm fundamental signals. So there are some patterns we can see, nothing very comprehensive, but just as an attempt to look into that. And another exercise we did is you can look at the 10K 10Q filings of the firms that offer portfolio take long or short positions, project those onto what we call textual factors that was developed in an earlier paper. It's actually related to, I think, Zheng Yang's earlier question about, once you have the word vectors, and you think about the factors of what vectors, you can do that. And we had some results over there. But safe to say, it's still very limited interpretability. And that's a common problem with deep learning models. And that's why, hopefully, I'll have time to touch upon the tree-based models in a bit, because they are much more interpretable. In a sense, they are not large models. Relative to deep learning models, they are very sparse. And yet their performance is actually comparable with these latest models from the AI field. Let me just push this reinforcement learning idea a bit more to corporate finance. And this is work in progress. Hopefully, we'll post the draft in a couple of weeks. Jointly with my colleague Marie Lo and a student, Lo Fengzhou, who just started his PhD at NYU Stern. So we've done a lot of work in corporate finance, but we also know we face some limitations in corporate finance. For example, in John Graham's AFA keynote, a presidential address, he was talking about how corporate finance models explain even in sample, maybe below 10% of the firm outcomes. Auto sample would be even harder. Todd Meaton was writing about there's as much P hacking in corporate finance as there is in asset pricing. And there's also a kind of sometimes not intentional bias towards fitting a particular theory model. So we define the variables in certain ways that's not very uniform or standardized. So there are basically need a more unified framework as well. And there are also critique by Spiegel in, I think it's in Financial Review, and I need to double check the journal, on how we often focus on static models that has a few periods, but leaving out the interaction with the market environment, be it competition with other firms or interaction with investors. Now, on the other hand, we do know we have abundant big data for corporate finance research these days. We have many useful, effective algorithms, AI algorithms that's used in other fields. We have reasonably powerful computation tools. And we also have come to realize that in the example I just shown you, large models could be very effective out of sample. So what we want to do here is we actually want to take this idea, right? Take a large model, train a large model outside. By the way, we've been working on this for almost 4 years on the server. So it's definitely pretty large computation, but it's tailored for financial applications, for corporate finance specifically. So here's the general idea, right? And many of you know a lot more than I do, so definitely would love to hear your comments. The way I'm viewing corporate finance models is we're trying to achieve at least two things. One is about underlying economic mechanisms, right? Theory models will be helpful, reduced form will be helpful, right? Because full causal identification will give us a very clear view of the world. But that view is local and low dimension, right? Because we have to tap into, some sort of natural experiment and all that. But it's under certain parameter conditions. And we typically focus on some low dimensional actions of the manager. But in reality, managers do a combination of actions. They do very high dimensional decisions in dynamic environments. And they don't fully know the market environment either. They have to learn about the market environment. So it's an accurate depiction of the world, but local and low dimension. It's hard to do interpolation or extrapolation. Now, so it's helpful for underlying the mechanism. It's not as effective for empirically explaining outcomes or recommending actions for managerial decision-making. Structural estimation, I would put it in the middle. It tries to balance this, right? We develop a model to describe the whole world, but the modeling space is based on theory models. It's based on models where we assume we know the evolution of the states of the system, right? To do dynamic programming, we need to know the transition probabilities, right? To estimate these models. But it's a restricted modeling space, and it's theory driven. There could be information in the data that tell us more beyond known theory. So how do we tap into that space? Can we have a data-driven, more flexible modeling space for producing counterfactuals, for explaining outcomes? And that's what I think reinforcement learning could be very helpful. And the idea is the managers are essentially doing a stochastic control problem, right? We know the states of the firm, we know the states of the market, and there's a number of decisions I have to make. So those are the controls. But different from the typical dynamic programming, I don't know how the market states are going to evolve. So I have to learn about that. And that's where reinforcement learning is helpful, right? I take an action, I see the reaction from the market environment, I take another action again. It's essentially a stochastic control problem with interactions with the environment and also allowing the market environment to be quite complex and unknown in solving this problem. So how do we do this? Actually, let me just show you the empirical exercise right away, right? So we can take the usual databases, data sources. In our particular example, we have about 19,000 firms, and we do quarterly observation. LS is a macro variable, which we have a monthly variables from Chicago Fed indices. Decision variables, we focus on the usual important ones, right? Decisions on leverage, are you issuing equity? Are you reducing, paying off debt, retiring debt? Acquisition decisions, right? Cash saving, R&D investments, so on. A lot of them are financially related. The decision set is probably bigger, but given that we are financial economists, we kind of focus on that. Computation, we were using not so fast the Red Cloud server at Cornell, but I think nowadays you can do this much faster as well with the newer GPUs and all that. But to run one round of estimation or update, it takes several days. So the idea is we develop 3 modules. One module is about the predictive market environment. If I take a combination of actions, how will the market and the states evolve after I take the actions, right? So that requires making a lot of counterfactual statements, necessarily interpolating and extrapolating the results based on historical data. So we'll figure out how to deal with that. But that's the market environment. So this is model-based reinforcement learning. The environment is modeled, right? And then we think about optimizing my policy, interacting with that. The policy part is done by your typical reinforcement learner, where you have state variables xt and your control variables ut. And both the current state and my actions could potentially affect the evolution of states and the market environment. And there's some stochastic knocks, right? So it's a stochastic control problem. In the follow-on study, we're looking at a situation where we don't know the objective yet. But based on reviewed preference, assuming the managers are taking optimal actions historically, what objectives they must have? Are they optimizing enterprise value? Are they optimizing ESG metrics? Are they optimizing shareholder value versus stakeholder value, right? You can do a decomposition. And that requires you to use a inverse reinforcement learner as well. And the two combined would be a general adversarial network. So if you're into the kind of algorithms, that's an interesting direction. So how does this environment module work? In terms of explaining outcomes, right, at our quarterly frequency and all that, this is the in-sample and out-sample R-square for some firm outcomes. Right? These are state variables of firms and market environment, how they evolve over time. Auto-sample, if you do assume the actions would matter for the outcome of the environment, you can explain auto-sample a high percentage of in terms of R-square, definitely higher than 10%. Even if you assume my action, I'm going to ignore my action. Why? Because from outsiders' perspective, standing at today's point, they wouldn't know the actions that the managers are taking, even though the managers know, right? There's some information issue. So even ignoring that, for many variables, you do have a high auto-sample R-square. And comparing these two, what that tells you is the controllability of that state, right? How much managerial action would affect that state. That's useful to know as well. Now, you could incorporate existing reduced form literature structural estimation results into this framework by the following, right? Suppose there's an empirical causal pattern that's well documented. You can require the environment to be consistent when it's in that parameter region. Right? That's one thing that the least we can do. If you have a structurally estimated model that you want to incorporate into this, you can use your calibrated structural model to generate data, and then use that data to train this market environment. So that's related to what is called transfer learning, right? You're trying to, and pre-training has that flavor too. Right? You use some other data or some other models to learn something and then incorporate into your new model. So that's doable. And there are many exercises one could do. One exercise is, suppose I just want to think about the recapitalization exercise. Well, I raise $1 of that or equity, maybe put it into R&D or some other actions. Accounting identity has to hold, right? Things have to add up. Subject to that, I can take very different combinations of actions. And if my goal is to increase enterprise value of the firm for the next quarter, auto sample, which action would create the most effect? Right? The enterprise value is a state variable of the firm going forward, right? So it turns out that certain actions, at least based on the data we observed, would be more effective. Raising equity, put that into investment is helpful. Number two is raise equity, put it into cash savings is also helpful. Again, do we see the underlying economic mechanism? Maybe not quite, but these are about pattern discovery. And of course, we can zoom further to think about what theory would explain why this is a more effective action package versus other actions. Now, the environment module has to be quite robust, right? Because we're doing a lot of interpolation and extrapolation. And the way to do that for us is we actually borrow some solutions from robust control that's applied in climate finance. A lot of work done by Tom Sargent, Lars Hansen, and co-authors. So there are a few ways to make sure I take the worst market environment and then do my optimization. If the market environment predicts results that are having a big dispersion, I introduce some penalty. It's a little bit similar to the idea of, I have a return to think about, also worry about the risk. If the risk is very high, my optimal action recommendation would try to steer away from that a little bit. And when the risk is very high, that also means figuring out the causality is very crucial. You need to figure out whether it's coming from demand or supply and all that. Versus where in other dimensions, in other cases, whether it's supply or demand, the outcome predicted are very similar. In that case, you don't have to worry about causality as much, right? At least in a data-driven way. So that's useful for understanding where causality or having that understanding that would be more crucial, right? Along what dimension. So those are some of the exercises one could do. You can look at maximizing the next quarter's market cap, and the alpha manager would improve relative to historical performance over 10% on average, assuming that's the objective of the manager. And of course, managers could historically have different objectives, and that's what the inverse reinforcement learning would help us to figure out in the third module. In terms of the recommended action, if you're just maximizing market cap next quarter, pretty short term, it turns out that holding more cash and reducing leverage would be more helpful than what is historically done by the managers in the data. So that's another example of how reinforcement learning would matter. I don't know how long, maybe a couple of minutes. I'll wrap up. Yeah, okay. So that's one space we can search, one search algorithm we could do. Another search algorithm, as I was mentioning earlier, would be using tree-based models. Take creating test assets, for example, right? How do we do a generalized sorting exercise to generate test assets, right? To try to span the efficient frontier to try to construct pricing kernels and so forth. Trees is a generalized way of sorting assets, right? Of sorting observations. But the limitation is that they typically assume the observations are IID over time, so it doesn't handle panel data. It's not quite for finance. The decisions are very local, right? I split one parent node into 2 child nodes. I try to minimize the pricing errors of my kernel there, but I'm ignoring all other data. So as the tree grows, I have less and less observations. I overfit. That's the main problem. How do we deal with overfitting? We try to use ensemble methods, taking average, right? Random forest, so on and so forth. But then we lose interpretability. We no longer see what things interacted to give the results. So one potential class of models would be tweak the tree model so that it can handle panel data and also guide the tree growth using some economic objective. So what would be one example? Suppose I'm splitting my return observations, right? Trees just try to generate some leaf portfolios by splitting along certain firm characteristic, let's say, right? Dollar volume, standard deviation of dollar volume. I can require the growth of the tree to maximize the Sharpe ratio when I do a mean variance optimized portfolio out of the leaf portfolio. Why do I want to do that? Well, if I want them to span the efficient frontier, Sharpe ratio better is high, right? I can use that to guide the tree growth. That's one possible objective I could have. In a later example, I could have a different objective, right? I could be thinking about, okay, traditionally we tried so hard to figure out a universal factor model, right? A common factor model to explain all assets. Yet in reality, we know the factors that explain debts versus equity are different. Factors explaining Chinese stock market will be different from US market. So we exogenously group observations, right, based on region and all. Is there a data-driven way that would inform us what assets should be put into the same cluster under what macro environment, so that we can figure out the right factors that price this group of assets? And trees can do that. Basically, the flexible model is I have these clustering outcomes, and also I can fit a factor model for each cluster separately. Right? I have to select my factors from the zoo of factors. What clustering would give me the highest likelihood of seeing the outcomes? That's something we could do in a Bayesian framework. And that gives us a very natural guidance for how to grow the tree, because suppose you use a frequentist approach, right? You use lasso selection of your factors for each cluster. You can fine-tune your hyperparameter, but how do you combine the hyperparameter across different clusters? Do I add them? Do I multiply them? It's unclear. But if you take a Bayesian approach, we use marginal likelihood that help us to integrate out model uncertainty and estimation errors from the clustering exercise. You can use that objective to guide the growth. And what it does really is, instead of working very hard on the right-hand side, we do some work on the left-hand side to cluster observations so that we capture grouped heterogeneity in the data. But arrow clustering is one example of group heterogeneity. That's something we've been doing for a long time. But here, the grouping is more data-driven. And if you do that exercise and search for a good model, you can apply it, for example, to US equity again. And what you can figure out is some anomalies and also factors are really just interactions of characteristics and reflecting heterogeneity of assets rather than systemic risks. So this is a way to combine characteristic and factors in a potential nonlinear way. Right? Traditionally, we talk about how they complement or maybe substitute each other. You can do that exercise. you can figure out what are truly common factors. Market and size turned out to be very common. But there are some clusters that are not priced by anything. And if you look at the characteristics leading to that cluster, they are essentially junk stocks. So they are not very priceable. Basically, what you learn is what cluster of assets are more priceable using factor models. And for some clusters, the auto sample R square can be over 24 to 25%. If you use traditional, even the most advanced factor models, not latent factor models, but let's say observable factor models, you get maybe 10% in that. And for some clusters, you can do a great job in pricing them. And you can do more. You can split the observations in time series. Then you'll figure out naturally what time regimes that are relevant for asset pricing we have. And then you can use macro variables to predict, okay, we are entering a new regime, and these are the relevant factors that price them really well, at least in the test sample we observe. And again, this is an economically guided way of searching in a large clustering large clustering pattern space, a solution that would help us to explain the dynamics and the cross-section of asset returns. Now, if you have other kind of data with group heterogeneity, you can do something similar. It doesn't have to be asset. But it ties back to the idea of goal-oriented search. So that's where I'll stop. Basically, I think that's the core theme behind recent AI development as well. Essentially, we are enlarging the modeling space, making them able to handle the natures of financial data, extract information, so on and so forth. But that space is very large. To do a full search estimation is very hard. So reinforcement learning and tree-based greedy algorithms would be effective algorithm to do that search. And the solution that's offered to us seems to perform better than our extent models, and in a way showing some sort of intelligence. Right? How did the machine manage to give us a good solution, be it recommending decisions for managers or deciding the prices, returns of assets. So I stop here. Okay. Probably ran over a bit.
Question on the audience. So, we are